Are you worried about coming up with a down payment to finance your next rental property investment? As a newer investor, the down payment is a big hurdle to overcome to get in the game and start building a portfolio. In this video, we're going to talk about a strategy that allows you to put less money down to buy a multifamily property. So hi, I'm Veronica Woods. This is the Real Estate Wisdom channel where we talk about how to build a profitable rental property portfolio, as well as provide market updates that impact buyers and sellers in the Philadelphia area who want to keep more money in their pockets. So in this video, I'm excited to share a conversation I had with a mortgage broker from my A team at Princeton Mortgage. And we talk all about how if you opt to live in one unit and rent out the rest in a duplex or triplex, that you have additional financing options. We cover a lot of ground in this discussion. We also even talk about some of the less talked about risk of using this strategy. I think it's a great conversation. So let's dive right in. So today we're going to be talking about how to finance when you live in one unit of the property and invest in the other. So some people call it house hacking. It's a really underutilized strategy to get into real estate investing. And I have one of my go-to lenders to talk to me about kind of the brass tacks of how do you finance these opportunities. So Katy from Princeton Mortgage, why don't you start by just introducing yourself?
Well, hello, thank you. I'm Katy Sychtertz. I'm an assistant branch manager at Princeton Mortgage. I've been in the business 20 years, so I've seen it all. There's not a scenario that, we haven't come across that, we can either advise on or make it work. And I like that creativity of finding a way to make it work for buyers, especially when we get into these type of properties and investments and things like that. So thanks for having me.
Yeah, and I was telling you before we went live that this is a topic that's close to my heart, because this is how I got started in real estate investing, by buying a duplex and living in one unit and renting out the other. And, I didn't do it on the first try. It took a couple tries to find the right property. And I think a lot of people just don't know enough about it. And just this kind of defining terms, some people call this house hack, that you can do this with a 2-family up to a 4-family and qualify for residential financing, correct?
That's correct. Yeah. So up to 4 units, it's still a residential home. Beyond 4 units, you are getting into commercial investments. But, there's so many opportunities in that 2 to 4 unit, property type for buyers.
And then we throw around terms like owner occupied financing versus investing financing. And how can you just elaborate a little bit about how lenders look at borrowers differently, whether they're going to live in the property versus not?
Yeah, so the biggest thing is your down payment. So if you are a first-time home buyer, or leaving a home and buying a home that you do intend to live in, it definitely opens up the doors that you don't have to come up with that big 20-25% down payment. You can do FHA financing up to 4 units if you're going to live in one of those units. And FHA is only 3.5% down. Conventional financing as a primary, if you're going to live in one of those units, still when it's a multi-unit, you have to come up with at least 20% down. But it really makes a lot of sense when these FHA buyers who want to, live there can go with the minimum down payment.
And maybe just touch on, we did talk about a little earlier about how the lenders view if you're not living in the property, and, depending on it for a roof over your head, how they view you as a little bit more risky. And that's why.
Well, you're a landlord. Okay. So you're at the risk of your tenants because the lender has an ownership interest in the home. we want to make sure that the condition is maintained. There's nothing hazardous or illegal going on in the property. You're maintaining the right insurance to protect you, which in turn protects us. So because that's a risk, the down payment, is greater. You want, the strongest credit score that you can possibly get there. The interest rates, can be higher on an investment property. And that's, again, where the strongest credit score is going to help keep your rate, at a reasonable rate, especially in this market. So there are some risks. We do look at it, as an investment, whether you're a seasoned investor or it's your first investment, that, we're going to walk you through that and make sure that, you understand the requirements of collecting rents and all of that good stuff.
Yeah, and I like to think of the lender as a partner in the investment when you acquire a property with a loan versus cash, because a lot of times people think like, oh, well, maybe it's better to purchase any investment property with cash, but I say, but kind of the bank is kind of helping you out in terms of making sure that the numbers work and that you are in the position to be successful, kind of alluding to what you were saying.
Yeah, and we keep you safe, having the mortgage on there, we do keep you safe and protected, make sure your insurance is going to, cover what we need it to cover. So, if you're a cash buyer and you might get, maybe a lower basic insurance policy, you may not be protected, if you have an issue with one of your tenants.
Yeah, now I talk back to just the overall house hacking. Somebody from this investment online forum, Bigger Pockets, is very popular amongst investors, came up with this term house hack. So I use it all the time. House hack, live in one unit, rent out the other, same thing. But one of the big benefits of doing that is the financing portion. So I know you touched on at a high level the down payments. And one good thing is it makes it easier to buy an investment property, almost like if you were just buying a property that you would live in. So I just wonder if you could just elaborate, what are the similarities between if you were buying a duplex and lived in it versus just buying a single family and live it? From a lender's point of view, how is it similar?
In the way we qualify you, it's all very similar. We're gonna analyze your credit as well as your income and your assets, where your money's for closing, is coming from. So all of those guidelines and those pieces that make up a loan approval is going to be the same no matter which type of property you buy.
Okay, that's good to know. Now, what's a little different in terms of
Well, the difference, whether you're owner occupied or investor, obviously is that down payment and the loan program. We can't utilize the government, the FHA or VA loan programs if you are an investor, and you do have to come up with that larger down payment. The other difference, of course, again, is if we're looking in a multifamily, is that there's income help, from the property to help you qualify. So a buyer who has, maybe just an income that would not qualify them for a certain price point on a single family could buy that same high price point if it was a multi-unit, because you are bringing in those rents, to help offset that mortgage payment. So a lot of people would be surprised, if they qualify for maybe a 200,000 sale price, single family home, that they can go upwards of 300 plus on a multi-unit because there's more income to help them qualify.
Yeah, can you speak more to how the lender looks at that rent that they can collect, and does that help them, and how do they count it? Is counted in the equation of how much they could borrow?
Yep. So with the rent, we determine that from what the appraiser tells us. So the appraiser does an operating rent schedule. When they assess the home, they're also assessing that neighborhood in that area and what an average rent for that square footage of that unit is in that neighborhood. And they will put that on their appraisal report. In qualifying, we always use 75% of that number towards our qualifying income ratios. For example, if it was $1,000 a month, we're counting $750 of that rent. You don't necessarily need a tenant in there. Okay, so we're assuming that your intention is to get your own tenant. So if it's not already rented out, that's not going to stop us from using it. It's just that appraiser's number. If there were a tenant in there, we necessarily can't use their rent, even if it's higher than that appraiser's determination. Okay. Because what happens with the rents and inflation and things, a tenant can come and go. So we always use that number to qualify.
Really? So if a tenant is paying higher than market rate, you can't use that number?
We can't use
wow,
that
I didn't know that.
for the tenant in place. We're going to always go off of the appraisal.
Okay. Because usually, so, I work a lot with investors, and as we're evaluating the opportunity, obviously we're looking at the sales price, but I'm also talking to them about the potential rent. Most of the time, I would say when people are selling, they're probably most likely undercharging. So I haven't seen a lot of what you just said, but it's good to know that it's possible that if owner they were buying a property that had higher than average rents, they wouldn't, as far as use it in a calculation of affordability, it's not to say that you can't keep the actual higher rent payment in your pocket, but as far as with the bank's view of your financial profile, they just knock it down. I guess that's what you're saying.
Okay. Yes, the bank's always going to go with that conservative approach and the safe approach, in qualifying. So wonderful. Yes, if you can collect much higher rent, do it. Collect it, bring in all that income and more. But we're always going to go that conservative and a percentage of that rent. So we don't even go to the full 100% that the appraiser determines.
Okay.
And the other thing I want to kind of touch on is, say you're buying a multi-unit and you do intend to live in one. But those units are already rented out. An investor already owns that property and there's tenants in all of those units. So you planning to live in one, we are going to ask to document that whichever unit you do intend to live in, that tenant has been notified that their lease is ending and they're going to have to leave. When you buy that home owner occupied, you are agreeing to move in within 60 days of closing. So that agreement with your existing tenant, telling them that they do have notice to vacate has to be in that 60-day window. So we know you're going to move in.
Okay, that's important to know. I mean, a lot of that is in the negotiation of the contract. So once you get under contract, in the due diligence, along with the home inspection, they are looking at the leases. And so the lease terms are pretty evident as far as, if it's already vacant, obviously it's clear, but then there's a negotiation of who gets the tenant out. And most of the times it's a best practice that the old owner give that notice and get them out, because as a new owner, you don't have a relationship. And especially if you have to do something in 60 days, you're on the clock. It's really hard for like a stranger to come in and say, hey, how are you doing? You have to move.
It's true. It's definitely on that current owner, that seller, because you don't own the property yet. We need that before closing, proof of that, notice. So it's definitely on that owner. So, we leave that up to their realtor to advise them on that. We'll let them know what we need. And we've never seen an issue in getting that, most sellers, their tenants know that they're selling the property and they could be subject to, not being able to live there anymore.
Well, otherwise, I mean, what happens is this closing date gets pushed off. Like I know, because sometimes there's different notification dates. And so if that is a term of closing that the property be delivered vacant, then the parties agree, okay, when can it be delivered vacant? I've asked that the tenant needs a little bit more time. I think we did a deal together. The tenant needed a little bit more time, and it all worked out because our client needed more time to get their financing together. The tenant also didn't move out when they said they were going to, but it all works out in the wash. It
all works out, everybody, and that's the thing, is we're all communicating with each other, me and you and the seller and the buyers. So everybody's always seeming to want to make it work. I haven't been in a situation where anybody's given it a hard time and, said, well, we can't push it off. Well, then you can't get your mortgage. I've never come across that situation. So if things have to push off, that tenant needs more time, we'll postpone closing, and we're just going to communicate with everybody and make sure everyone's on the same page. And we know, when we can close, what date is going to meet everybody's needs.
Mm-hmm. Is there anything besides the making sure, because you brought up an important point, that you have to be prepared to move it, take possession in one of the units in 60 days. Is there any other things that people should watch out for when they intend to use that strategy?
Yeah, well, we are going to ask which unit you do intend to live in, because depending on that property, each unit can really have a different rent assigned to it, depending on, well, this unit is larger than this one. And the appraiser is going to, when they determine those rents, they're going to put a rent for each unit A, unit B, unit C. So again, we're going to just kind of look at that detail, not necessarily, okay, you're going to move into one of the units. We want to know which one, because the unit you're going to live in, obviously I'm not counting that rent. I'm going to count the rent, if it's a triplex, on the other two units. So that's also kind of important, that when the buyer goes in there planning to occupy, that they know which one they want to occupy. And of course, that's the tenant that's going to vacate.
Okay. And I forgot, did you mention, isn't there a difference in the down payment for 2 units versus 3 units and 4? Like, it's not, I think there's a scale to it, correct?
Yes. If we're going with conventional financing, 2 unit, you can put 20% down. Now, on any multi-unit, 2 to 4, it is advised to try for the 25% down, only because the rates kind of are a little bit better between a 20 and 25% down payment. But, if you're only working with those 20% funds, we'll make it work for you. Again, if it's FHA and you're occupying, you can put 3.5% down, whether it's a single family or 4 unit, so that's kind of that nice benefit there. But conventional financing, occupying or not, 20 to 25, depending on how many units you've got.
Okay. And we didn't talk about renovations. So is there room to, and I know that the rules, as it's 2023 now, have evolved over time in and out of favor based on the economy, but where do things stand with getting financing for renovations?
At this time, the renovation product available is only a conventional one called a home style. And for now, that's on primary residences. Okay. Single family. FHA has their 203K product that has been suspended since 2020. But there is talks, all the forms, everything that we're reading is that FHA 203K is coming back this year. And that will allow you to do those renovations on the multi-units. Again, FHA, you have to live in the home. You can't buy an investment property using FHA financing, but that's your way of, again, especially if it's your first investment, taking on this multi-unit property, living in one, fixing it up, and getting to a point where it's self-sufficient and you can move on and, buy your next home or your next investment from there.
Okay, now you mentioned something, move on to your next investment. So how many times can you do this strategy where you live in one and rent out the other? Can you repeat that over and over for a while?
So we certainly don't want to see property hopping, where you buy one, live in it, a year later, buy another home, live in it, a year later, buy another home and live in it. And that will all show on, our background checks that we run and everything. Because that's it's a red flag. It's kind of a way of cheating the system, and trying to avoid investment property loans and putting that larger down payment. So you really want to be safe and cautious with that. So when I say your next investment, it might be, hey, this is not the home of my dreams. This is not my permanent home where I want to live, but this is my way of stepping into real estate, building up equity, building up assets, as well as income, because once you start showing those rents on your tax returns, now your income's greater, that you can qualify for, maybe that single family home of your dreams for you to live in, or qualify for a future investment where you're going to stay in that and buy another home.
Okay. Now, is there kind of like a gray area with this? I've never heard the term investment hopping.
Yeah.
So you kind of touched on something I know what probably people are thinking about. Well, I thought that's the whole point of this strategy.
So when you do it too quickly and too often, it's good. You're going to be flagged, and they're, like I said, their underwriters are going to be a little bit suspicious, okay, they're changing their driver's license, they're filing their tax returns, they can prove that they truly lived there rather than saying they're going to live there, because that is the biggest form of mortgage fraud is, the occupancy, because people don't want to come up with that larger down payment. So you just want to be really cautious and of course talk it out with us. Exceptions can be made to the rule, things that make sense. but we're going to address it and talk it out, have you document further, that you truly are going to live there, just to avoid that sign of fraud that, you're buying up investments, and saying it's a primary.
Mm-hmm. Well, I think it's there probably is a difference of when, and I have had clients say, oh, when I'm going to buy a multifamily, my son lives there. I'm like, whoa, like, is the son actually going to live there? Like, so I definitely ask those questions and, mention that the fraud thing is a serious thing and you're signing off at the closing table. Mm-hmm. But the other is, somebody like me, like I did really intend to live in the property, live there a few years. I can replicate it again, and I intend to live in the property. There's a difference. I guess I just want to make sure there's a difference.
Yeah, and the big piece of it is that timing. Mm-hmm. If you're doing it, like I said, in a year or less, over and over and over, okay, that's where it's flagged. But yes, if you're there for, a couple of years, and obviously we're upgrading our homes, we want more space and everything. When it gets to leaving one multi-unit, moving into another multi-unit, moving into another, you're acquiring all of these, these investments that might be frowned upon. Going from a multi-unit to a single family makes absolutely a lot of sense. And then even exiting that single family and going to another one. So we're just looking for that common sense to believe that you will live there. And everybody has their own unique situation. So that's why we do talk it out with our buyers and find the reasoning behind it and their motivation for doing it, and can present that to an underwriter and make sure that we're not going to have any hiccups once you go live under contract with that intent.
Okay. Mm-hmm. Well, just to wrap up, is there anything else and that was, I guess, a good warning. Yeah. You added, I didn't think about, your perspective of a lender and what you, using some popular investment strategies and how you could potentially get yourself in hot water if you're not really doing it thoughtfully. Is there anything else that you would bring up that people should think about?
I would say, and it's just the season that we're in, being in tax filing season. Obviously, once you do, acquire your home and you're collecting rents, you do want to, make sure that you're trying to show that income on your tax returns in a strong way, not try to write off a lot of that rental income, because that income, once you buy your next home, the current property that you own, we're not getting another appraisal on to determine the rents on the home that you already own. We're going off of your tax returns and the income that you're showing on those units. So you want to always make sure you're showing your rents properly. Obviously, you can expense, write off the housing expenses and everything. We want that positive number on it's called your Schedule E on your tax returns, just to help you qualify for your next home.
Okay. With that, I think we covered a lot about the benefits of living in one unit and renting out the other, and really allowing you to buy more house than maybe you otherwise could if you were just going straight away and buying a single family or a multifamily. And it really is a gateway into becoming a real estate investor. Like I said, a lot of times this is people's first dipping their toe into it. And so Katy, where can we find you?
So we can share my contact info in our comment section here. But I am with Princeton Mortgage. I'm on Facebook. I have got a website, so you can very easily find me. My phone number is 610-247-2894. That's my cell. Text, call anytime. Always happy to answer questions or just talk out scenarios to, help people just get better informed.
Okay. And like you said, Kate, I'll have all that in the notes below this video. And thanks for chatting with me.
Well, thank you. I have to say, every time we have a transaction together, it's always so smooth and seamless. I'm always looking out for a buyer's best interest. So I love that you are as well. And that's key. It's huge and helpful to the buyers. They always come into this, sometimes with those questions and confusion, and you having the experience in purchasing so many properties and everything. It's just great to be able to advise them and educate them on it, so they're comfortable and confident,
Now, the one topic that we didn't explicitly explore in this video is rates. The reason why is because at the time of this recording in early 2023, the rates have been all over the place, and every week we're watching and see if it's ticking up and ticking down. So we wanted to really discuss the fundamentals of how you are evaluated as a borrower in this discussion. But I do want to bring up 3 points that you may be thinking about, and I just want to put it out there before we wrap up this video. So the first point is, in general, if you have a pure investment loan versus an owner-occupied loan, you're going to pay roughly a half a point up to a full point more in rate. So that's just the given. The debt for an investor loan is going to be more expensive than a full owner-occupied loan. Second is that, and something that Katy did allude to or mention in the discussion, is that even though you can put down less in a case if you're living in the property, there is some incentive to want to put down the 20 to 25% preferred, the bank's preferred share of equity, because that will also give you lower rates. So it's just something to think about. The more money you put down, the lower the rate that you would get. And lastly, make sure you're running the numbers or evaluating opportunities on the current rate. Don't go by what you heard on the news or saw on the website 3 months ago, because those rates may be totally irrelevant at this time. Now, if you want to watch more or learn more about how the pros of buying a multifamily and how to do it, how to do this house hack where you live in one unit and rent out the other, you want to watch the video that's appearing on the screen now. As always, thanks for watching and happy investing.